All right, so I wanted to make a video going over the last week's news. We had a handful of things happen. We had the Fed raising 25 basis points. We had another bank failure. We had a very busy week of earnings, so I'm going to go over all of that stuff today. Again, first thing, we had another bank fail. Not overly surprising, given we've already had a handful already. And again, as far as the 25 point rate hike, that wasn't surprising either. That's what the market was pricing in. Although what I think is surprising is how hell-bent the Fed is on causing all this damage, right? Now, again, they're worried about inflation, right? To be fair, they're worried about inflation, but the market's already pricing them to be cutting rates by the end of the year, and it might even happen sooner. And I think I'll go out on a limb and say that they will be cutting rates by the fall, right? By the fall, maybe even in the summer, because they're doing more harm than good at this point, right? And the more they want to be hawkish, the more damage they're going to do. Hence why I'm going to make this prediction. Again, that they'll be cutting by the fall. Do I have an exact date? No, I'll say maybe September or October, right? Just my prediction. Now, what will happen to the market? I don't know. I've seen people say the S&P is going to go down to 3,000. I don't think that's going to happen. My guess is that we test the lows from October, so we're looking at probably around 3,500 on the S&P. But again, for all we know, it won't go down further, right? It won't go down for it. Won't maybe 4,000 is the low, right? Maybe that's the recent low, right? Nobody knows, right? That's the one thing I would say. Nobody does know. But again, the yield curves, all that stuff is pointing towards they're doing too much damage and they're going to be cutting by the end of the year, if not sooner, right? I think sooner. As far as the bank collapses go, again, this stuff's going to keep happening. It probably will slow down, right? But, cracks in the system are going to keep showing themselves until something changes, right? So again, as far as the market goes, the S&P was down slightly on the week. It started out at about 41.74, finished at 41.36. As far as the NASDAQ goes, the NASDAQ was about steady. It started out at 12,218, ended up at 12,235. As far as other things go, Bitcoin, again, always got to follow Bitcoin. It was up actually pretty nicely on the week. Also, where is it on the month? Also up on the month. Bitcoin, it may set up very nicely for Bitcoin, because if we get a Fed cutting cycle into the Bitcoin halving cycle, we're going to see one hell of a bull market in Bitcoin. Right? Either way, we're going to see a bull market. I don't think it matters what the Fed does. The question is, if it's into a CARES Act 2.0, Fed cutting rates down to zero again, I don't think they go that low, but I do think they will cut. We're going to see a hell of a bull market in Bitcoin, right? Again, just my opinion, but that's what I think is going to happen. As far as earnings go, like I said, we had a lot of companies release earnings this past week, most notable being Apple. Apple beat earnings. Revenue was up. The price, although the price was up a little bit as well. Apple's done very well over the last year. I mean, year to date, it's up. What is it up year to date? It's up 32%, right? Which is just utterly insane. Even over the last year, it's not going to be up as much. Still up 12%, right? And that's a year where the S&P I don't think is up that much, right? So Apple has outperformed the market. It's grossly outperformed the market this year. Of all the big tech stock, I mean, if you take the top 10 stocks in the S&P 500, if I were to choose just one, it would be Apple. Now, would I be betting money that it's going to perform the best over the next 10 or 20 years? Probably not. But I do think that it has the best moat. It has the best a lot of things, right? It's growing its dividend very nice. They announced a dividend increase, which I like to see. I find that very valuable. A lot of investors don't find that very valuable, but I do. Again, current growth rate just under 8% per year. It's only at 0.5%, right? But if they can grow at 8% a year, I don't care, right? I really don't care, right? So again, Apple's looking very good. It is probably getting, let's see its valuation. I'm guessing it's getting expensive where it's at right now. Yes, the price of free cash flow is at about 27, 5-year average 21. So keep in mind, it is expensive for where it's at right now. But again, this is a company that it's going to almost certainly outperform the market. To be fair, it is. I think it is the largest percentage of the market, right? So when these big tech companies have big moves, it moves the market, right? So that's another thing to keep in mind. But very good company in my opinion, right? Although given how big it is already, like I said, I don't think you're going to see crazy growth. The next one is one of my more favorable companies, Universal Display. They just barely beat earnings. Revenue is down slightly year over year. They were up slightly, although if we look on the year, they're actually up nicely. On the month, I think they're down a little bit. The week, they're up slightly. Again, this is a company that, again, they're the ones that are making the stuff for the TVs, computers, phones. Very good company in my opinion. They're growing their dividend very, very, very nicely. They do have a pretty good moat, as far as I can tell. Dividend yield of about 1%. Although again, on a payout ratio, that's only 31. So they do have quite a bit of room to grow that. The one caveat, they are very expensive where they're at right now. Price of free cash flow of 80, 5-year average 60. That's still very high. Price of sales of 10. If you're looking to get in, I think it's expensive where it's at right now. But again, I do like this company over the long run. As far as the next one goes, Arbor Realty Trust. Given the industry that they're in, I'm kind of surprised that, again, they destroyed earnings 62 cents a share. 44 was the estimate. Revenue's up. The main reason you're buying this company is the dividend. It's well into the double digits. Let's see the exact amount here. 13.6%, right? So that's why you're buying this company, is for that dividend. You're not necessarily buying it for the growth. When you factor in the dividend, this company has outperformed. It has actually, it's roughly even with the S&P over the last 10 years. So again, you're buying it because of the dividend. I do have a small position, although I'm not super eager to get more at the moment. Although given it beat earnings very nicely, is actually kind of a good news, and it actually appears to be fairly well priced where it's at. So it is a fairly risky position in my opinion. But again, given that dividend yield, I don't think you can go wrong, right? I mean, at least to have a small position. Next one, Wheaton Precious Metals. Again, don't have a position in this company, but I do want a position, although gold prices are very high at the moment. And again, it's clearly very well above its average price of free cash flow. I would like to get a position in this company, although, again, I'm waiting for it to get cheaper. As far as earnings go, it missed earnings, and revenue was down. Share price was up, though, right? And I think that's mainly due to the price of gold recently. The next one, ANET, or Arista Networks. Again, this is a company that I want to get into, but it's very, very expensive, and I don't know if I ever will get into it. Price of free cash flow of 93. 5-year average is 38. If it could get down to there, I'd probably consider it. But it's just a very good company. I mean, look at crazy good returns, crazy good profitability, crazy good growth, crazy good balance sheet. Everything looks great for this company. But again, they're just crazy expensive, right? So I'd love to get it cheaper. They did beat earnings by slightly beat earnings, so that's good to see. The next one, CF Industries. This is a fertilizer company I do have a small position in. They are one of the better ones in my opinion. They beat earnings fairly nicely, actually. It is down in price year over year, but that's mainly probably due to the Russia stuff. If you look at Mosaic, who's another company that's in a similar industry, They're down. They're at a 52-week low. They missed earnings. Revenue and sales are both down. Again, partially probably due to that Russia stuff. But again, CF Industries is doing really good. They're probably the best between them, Mosaic, and but of the big fertilizer companies, they're probably the best, at least in my opinion. If we want to go to the next company, SoFi, I do have a position in them. I'm kind of regretting it, to be honest, because this company has not done a whole lot, right? I mean, year to date, it's basically flat. This is a company that did very good, 2020, 2021, or basically right after it IPO'd. It opened at $10.26. It hit as high as about $25 a share, and ever since November of 21, it's been down ever since. It did get as low as about $4.30 roughly, so it is up slightly since it's low, but this is a company that I think it got hit pretty hard because of the banking stuff that's going on. It's also gotten hit because of the student loan stuff. As far as earnings go, revenue is up. Earnings per share is up. So that's good news to see. They are growing, but with the banking issues and stuff like that going on, I think we're going to have to wait until that stuff gets resolved before this company can get into a clear uptrend. It looked like they were in a nice clear uptrend, late this year or late last year, early this year, but basically ever since February or early February, the price has been going down consistently. So we will have to wait and see as far as that goes. The next one here, Vici Properties. This is one that I am dollar cost averaging into. They own casinos and a lot of that kind of stuff in Vegas. Again, main reason you're buying this because of the dividend, 4.75%. They are growing it, I think, somewhat well as well. Yeah, 8% a year. That's solid. As far as the earnings go, revenue and earnings were both way up, right? Both way up. So that's exactly what I'd like to see. If you look at the FFO growth on this company, which is again what I'm most concerned with. Look at the growth here. Just very, very nice. Again, I guess 2021 was only slightly higher than 2020, but 2022 was way higher. So again, they're growing very nicely. They have a very nice dividend, and like I said, I think they're growing very nicely, and just a solid company in my opinion. I don't think you're going to get crazy returns, but I think a very solid company in my opinion. The next one, and probably arguably the second most anticipated company as far as earnings went this week, AMD. As far as earnings go, revenue was up, earnings per share was up. Sales was down quite a bit though, and that's due to PC sales being down for them, which was expected, right? I mean, everyone was buying their computers for 2020, 2021, so I think it was expected for that stuff to be trending down a bit. But this is a very good company, not very good. This is a solid company in my opinion. I would like to get into it, but I would like to get into it when it's cheap, and it's not cheap, and I don't know if it ever will get cheap. 44 price to free cash flow. It is way below its 5-year average, but 44 is just, I don't care pretty much no matter how good the company is. 40 probably is my limit, preferably below 30, right? You got to be growing very, 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 very nicely to pay 35 or 40 price to free cash flow, right? If your goal is to dollar cost average and hold over 30 years, okay, maybe it's not the biggest deal, but this company is too expensive to buy under any scenario, in my opinion, right? The next one here on the list, Extra Space Storage. This is one of the self-storage companies. Again, I like to watch them because I think that this is a solid company. Is this the best self-storage one? Probably not, in my opinion, but I think they're very good still. They're growing their dividend very nice. They have a 4.2% dividend right now. They beat FFO expectations nicely. So, and again, this is an area that I don't know how, is it going to get hit super hard in a recession? It's definitely got hit a little bit, but I don't think it's going to get hit super hard in a recession, right? So, again, just my opinion, but I think that it's a solid industry to have some exposure to, in my opinion. Franco-Nevada, again, this is one of the big mining companies. Again, that's why I follow them. I don't have a position, but eventually I might open a position here. They beat earnings by a little bit. And again, if we're going to go green, then companies like this are going to do well, right? The companies that are there doing the mining of copper, iron, all these rare earth minerals, they're going to do well. The problem is, when's it going to happen, right? And who's going to do it, right? There's a lot more logistical problems with that stuff than I think people realize, and that's why I'm a little bit skeptical. Next one, One Oak. This is I think mainly natural gas. I think they have a little bit of oil as well. Again, they're a solid company. You're buying them mainly because of the dividend, 6%. I think that there's ones that are better, but I think it's a solid company as well. They did beat earnings nicely, which is why I wanted to talk about them. The next one, another energy company, Diamondback Energy. They missed earnings. I think they're a solid company as well, but they did miss earnings, which is a little concerning for me. The next one, Fortis. This is a company I do have a position in. Again, just one of your classic boring utilities. They did beat earnings. Also, revenue is up. I wish they were growing their dividend a little faster. If they were growing their dividend a little faster, I would be more gung-ho about this stock. They are growing it consistently every single year, but again, it's only just under 6% a year. I wish they were growing that a little bit better. Although I think of the utilities, they are one of the better ones in my opinion. As far as the next company goes, Realty Income, this is a very popular REIT. As far as earnings go for them, they were up very, very slightly. Revenue was also up slightly. This is a company, again, you're buying because of the dividend is the main reason. 5%, just under 5% right now. They are growing at 3% a year. I think they're very popular amongst the dividend community, but I think they're overrated in my opinion because they're not growing very fast and they're also not growing their dividend barely. They are growing it, but barely. Not that I think they're terrible, but I think that there's better options in my opinion. The next one is Coinbase. Again, like watching them because of the crypto aspect. As far as earnings go, they did beat earnings actually by a lot. They are expected to be losing 44 cents a share. They made 15 cents a share. Revenue is down slightly. So again, I wouldn't necessarily buy a company like this. I think you're better off just buying the crypto, specifically Bitcoin, in and of itself. But I do like watching these companies just because I'm curious, essentially. Next one, ConocoPhillips. They beat earnings very nicely. Revenue is down year over year, although that's mainly due to oil prices. They are one of the better oil and gas companies in my opinion. I do have a small position in them. Another one, the exact same story, EOG Resources. Again, another very good oil and gas company. They beat earnings nicely as well. Revenue down, same story. I do have a small position. Again, they're one of the better companies in my opinion. Again, just under 3% dividend. As far as the dividends go, they are actually growing it very nicely as well. Although, again, that's going to depend on oil and gas prices. The next one is Microchip Technologies. This is a company that I do, of these semiconductor companies, I do like them. They're one of my favorite ones. Number one, because they're growing very nicely. Number two, because they beat earnings. And they have a very nice dividend, right? Just under 2%, but they're growing at 14.5% a year. Payout ratio only 37%. So they got a lot of room to grow. And they're growing that dividend very nicely. In fact, they actually kept it basically flat ever since late 2020. They started growing it very nicely, which is, again, exactly what I want to see. And the last company I wanted to talk about today, Westlake. They have some subsidiaries as well, but I do have a small position in this company. As far as earnings go, they beat earnings by a lot. They beat it by a long shot, which is good to see. As far as the dividend goes, they're growing it fairly steady as well, 11% a year. Again, it is pretty small, but again, payout ratio is only 8%, right? So they got a lot of room to grow that dividend, right? Those are the kind of companies that I really like. I'm not saying this is the perfect company by any means, but those are the kind of companies that I really like. The ones that are growing that dividend very nicely, 10, 15, 20% a year. and they got a lot of room to grow it, right? That's exactly what I want to see. So that wraps up the video for today. If you liked the video, make sure you hit that like and subscribe, a comment. I'd love that as well. And stay tuned for more.